Hello and a very good afternoon, everyone. This is Megha, your host, with my co-host Lalita, and we welcome you day 9 on Investment Pathshala 2023. Today, our speaker will explain to us how to decode a term sheet. We have our very best speaker with us, Mr. Rathnakar Samavedam, Investment Director and CEO, Hyderabad Angels. We welcome you, sir.
Thank you. Thank you all.
And it's a pleasure to have you with us. The session is about what purpose does term sheet serves, what are its silent features. Now, sir will explain in details about this topic. Sir, the stage is over to you.
Thank you all. Thank you all. And first of all, Happy New Year to all the viewers. And also Happy Bogi and Sankranti, which is done mostly in South and North. I wish you all the festive seasons and seasons greeting. So I think Jabalpur Incubation Center as a part of the education series for both investors and also for the startups, they ask us to speak about decoding of the term sheet and SHA, shareholders agreement. The first and foremost question, why the term sheet should be there? What is the reason of the term sheet? In case of legality, the court has asked what is the witness, what is the evidence that there is a contract between both the parties. All of you people need to understand the contract law. The contract law says is if two parties are discussing each other, they entered into an agreement orally, it is also still valid. The problem, what really happens is when you go to the court of law for any resolution, they need some evidence. What is that evidence is what they look at. The evidence is mostly paper evidence, which has been signed by both the parties. Today, email, I think under Information Technology Act, sending documents on WhatsApp, sending documents on email is a valid evidence for them if it is the email ID which has been registered. So, when we are speaking about the contractual obligation between both the parties, there is various steps under which an agreement will be entered. I hope you all will agree on that. So now in the startup world, not only startup world, prior to startup, there were private equity investors who are putting in money in medium to large companies where they can grow the company to certain level and go for an IPO and an exit. But when investors are coming in, who are the investors today? Investors are all of them are financial investors. None of them are strategic. None of them are co-founders to you. Investors who are financial investors, what is that they are doing? They are putting money into your company. They are looking very passive. They are not active in day-to-day operations of the company. They're only believing you, saying that this particular founder is doing well, this business idea will work well. This is the problem statement which he has addressed, which is the need of the hour for all the customers. At the end of the day, customer is the king. So based on that, they are putting the money, they are doing their job, and startup entrepreneur is doing their job. Now, after taking the money, if startup founder doesn't honor certain commitments and investment goes for a toss, generally in general domain, you all will agree. Are Baba, why you are not taking any agreement? Why don't you have a formal choice? What is that he is doing? The questions will come now from all the parties. I hope you all agree. So, in order to avoid that situation, there is a formalized structure. They said when an investor is putting in money, he should have certain agreements in place. So, when the investor is putting money, before that, both the parties should come to a understanding why he is putting the money, what is the purpose of putting the money, why he is asking the money, what is the purpose the money has been asked, what are the rights of investor, because investor is a passive. Again, remember, he is a financial investor, he is a passive investor, he is no more an active investor. What are the terms and conditions between both the parties? We should have some understanding, right? How do you know that we both discussed? We send a mail, this is my rights, this is my obligations. When I put money, these are the things you need to follow. So that is where this term sheet plays a key important role. Understood? No, this is the term sheet which plays a key important role. Understanding the terms under which you are seeking money, the terms under which he is putting the money into your company. You can ask Rathnakar sir why we need to have a term sheet. As I said, the initial, my conversation around 2 3 minutes back, there is a contractual obligation between both the parties and evidence is needed. What is that? You both agreed. That is the reason the term sheet plays a very important role. Understood? What is term sheet? As I mentioned in the PPT which you're seeing, the term sheet outlines the key terms of investment between the both the parties. The term sheet is a contract between startup and its investors. It lays out the terms of investment, including amount of money involved and terms of investment. Understood? This is the key area, one of the critical step when two parties are entering into a transaction. And term sheet also plays a very critical role. I will tell you generally what really happening in today's world is startups are seeking funds. They created a pitch deck. And the pitch deck is what they are sharing to us. Each pitch deck is an evidence. Yes, it is an evidence. Each pitch deck has certain terms and conditions. No, pitch deck doesn't speak about terms and conditions. What is the pitch deck is discussing? Pitch deck is discussing about what is the problem statement you are trying to address, what is the solution you brought on the table, how it is relevant to the current environment and to the customer. Then you are discussing about the market opportunity. Then you are discussing about go to market strategy. And why you need or why you are seeking these funds is what you are proposing in that pitch deck, right? It doesn't say anything. And this pitch deck goes to at least in some cases, people are lucky they may get funding in one or two investors. In most of the cases, it goes to 30 to 40 minimum investors before it sees any kind of acceptance and willing to come forward and listen to you. I hope most of them would have done. Once the investor thinks it is a good business model, I am interested to invest, he will come, he will discuss with you, and he discuss on what is your investment thesis, pattern, and other thing. If they like, they issue the term sheet, right? So, what are the various terms in the term sheet we have today? What is the various terms we discuss about the term sheet? One of the critical factor One of the critical factor we discuss in the term sheet is valuation. We'll go for negotiation. One of the key important term sheet which we discuss is about valuation. The valuation has to be discussed. Without valuation, term sheet has no sense. So when nowadays, I think most of the startups are well educated. I've been in the system for more than 5 years plus. I see, Rathnakar, what is your general terms and conditions of your investment? A lot of people are asking, what is your general terms of investment? Without putting valuation, without putting what is the investment you are going to do, you send us what is the general term. So we were very happy that the founders are very well aware of the term sheet and they are trying to address this particular point, what need to be done. Understood, no? So why I'm saying the valuation is a critical point now. See, financial investors' interest is investment in your company. He will try to bring some value add. Most of the today, if you see micro VCs, angel networks, angels, they're all saying that we will not only invest money into your company, we will also try to bring the business connects. I hope you are hearing these words everywhere. You have to come to me for taking money and also try to get some kind of business connect. We will try to help you on certain areas, even on recruitment of the manpower, even on doing all these things. That's what you see with most of them. What I observed with many founders today, why valuation is critical. As per the Companies Act 2013, any person, any angel network, or any VC which is holding more than 15% stake in the company, they are called as substantial investors. What is the difference of the substantial investors? Substantial investors means those investors who have an obligation towards tax liabilities. government compliances, creditors, they can sue even the substantial investors. Why they said this? If you're holding more than 15% or 20% in the company, if founders are not acting, because your startup is built on four things, please remember. The first and foremost thing is customer. Without customer, no startup is surviving or any company is surviving. The second is your suppliers. The third thing is, who is the third people? Employees. Understood now? Customer, suppliers, third is the employees. The fourth is the society. Society includes investors, stakeholders, compliances, government, all the people are involved in the society. You have to manage these four pillars very tight. Anything is getting disturbed, you will have a trouble. Understood now? So that is the reason we were a lot of startup founders I seen at early stage. They dilute a stake more than 25%, 20%, 30% in the company unknowingly. Now, what is the bad thing, sir, if I dilute 25, 30%? Yes, today any startup which has to survive from a small stage to later, they call it as idea, MVP, customer revenue generating stage, then to going towards growth stage. Lot of VCs before raising Series B. Please keep in mind, before raising Series B, that means you are raised Series A, bridge round to Series B is also raised. Before raising Series B, founder should hold, the founding team or founder should hold, excluding ESOP. I see a lot of founders says, sir, we have ESOPs. No, excluding ESOPs. You should hold anywhere between 45% to 55% in the company. Anywhere between 45% to 55% in the company before raising Series B. If you have diluted, if there is a potential dilution in the company, the founder stake below 45% before Series B itself, the chances of company getting further round is troubled. Understood now? The chances of raising Series B is a big trouble. There are totally, as you look into the statistics, totally 62,000 recorded startups as per government today, out of which 8,400 startups has got funding in some form or other form. That is equivalent to around 15%. Today, if you look at 13 to 15%, out of 8,400 startups, only 2,000 startups have crossed Series A. Understood now? Please understand, this is where we are. Not many people are able to do that. Series C and above has been done only by 300 to 400 startups today. Not many were able to cross. And 108 are the unicorns today. So, valuation terms is very, 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 very critical. In your term sheet, please observe that point. Valuation is very critical. So a lot of angel investors are asking, Rathnakar, how do you value? How do you value this company? No. See, the valuation is a myth. Valuation is an art. It is not a science. There is no formula for valuation. But if you look into many of the registered valuers, merchant bankers, today they are crying, how do I value a company which don't have revenue? Because government of India in either Companies Act, nor Income Tax Act, nor RBI regulations, nor SEBI regulations has changed the valuation method beyond discounted cash flow. Correct? You all agree, right? That is beyond discounted cash flow. I can't value any company. They want futuristic discounted cash flow under which the valuation will be done. And they are coming with certain troubles. They are coming with certain points, and each one is putting different angle. For me, till you reach a level of Series B and above, it's a different term, Baba. Don't consider it. There. The investors' valuation thesis outlook is completely different. Till Series B, where most of the companies have to change that particular milestone. What is that we are looking? You need to justify. For example, if you're asked, I think many founders will come and ask, Sir, I need 1 crore, I need 2 crore, I am trying this, I am trying that, I am okay for 25 lakhs. Other day, I think in Shark Tank, one of the founding member was crying who was running some activity that he needs funds to sustain and he is okay for any kind of valuation. No, please, if I will tell you in the investment world, any founder is asking money with emotional connect, trying to sustain. There are no investors. Please understand, in financial world, emotion has no role. Emotion has no role. It is purely whether I put money, can I make my valuation greater? They're not even. So I think good olden days, a lot of people used to say, "Hey, Baba, you start the company. I'll give you some money. I'll take 50% stake. You run with 50 because money is mine. Hard work is yours. Whatever cash flow you're going to generate, I will take back." I see some businesses are still running in that context. But in startup world, it is a valuation game. It is a growth. Why this sudden change has come, sir? Purana, though people used to say, okay, I'll put money, I will take money from my profits. Now profit and a word is gone. Now people are looking only for the growth. Why? The reason is very simple, ma. Today, previously, what used to happen for any founder to start any industry, his market is his place. For example, if I need to start any company today, my market is Hyderabad. Beyond Hyderabad, I don't have a market. I don't know where I need to go and set up my company, right? You all agree. That is where I stand today. But if you look into the current startup world, because of the digital presence, you can reach customer anywhere in the world. For example, for any DTC company, from Kashmir to Kanyakumari, from Mumbai to Guwahati or Arunachal Pradesh on the end, the market is fully opened up. Correct? And you have to reach to customer much faster. You can order online. One of the good thing happened is last year December Amazon launched US also. Correct? You all agree. So that is the reason today the growth is exponential. When the growth is exponential and you're trying to capture companies, you're trying to capture customers, you have to burn cash. We are saying we are okay to burn the cash, justify what is the amount you need, justify what is the amount you need, then only we will. Some disturbance is there, then only we can take it forward, otherwise we will not take it forward. For example, your need is $2 million, you are justifying your ask today. If your need is $2 million, if you are justifying your ask today, if I'm a financial investor, I don't want to take more than 15%, or I'm okay to stretch up to 20%. The valuation of pre-money valuation is 4, post-money is $5 million. Sorry, pre-money valuation is 8, post-money is $10 million. This is where the valuation comes. Please justify your ask. Please justify the milestone what you wanted to reach. Understood, no? What is the milestone you need to reach? Sir, we have confusions on milestones. The milestones what you need is what a Series A investor is needed, what a Series B investor is needed. Today, most of the milestones more or less defined for every industry by the VCs. This is not the case around 5 years back. There was confusion. Now industries have flourished, startups have flourished, milestones are more or less flourished today. Correct? You all agree. So justify that. So one of the key term you need to look into the term sheet is valuation. Rest of all other factors will come in play. Come in play. Okay. Now there are two important points when you receive the term sheet you need to be noted. I'll speak about the other terms in the term sheet. Two important points you need to observe. When the term sheet is received, on the top of the term sheet, they will write as draft term sheet. Please observe, when they say draft term sheet, it is not final, it is for negotiation. If you try to share the draft term sheet with any other investor saying that I got the term sheet from some so and so VC or so and so angel investor, it is not treated final, it has no value. It is discussion between both the parties. I see many for startup founders sending me draft term sheet. See that the word draft has to be removed. Second thing, when they say term sheet, the second condition they mention is non-binding. Here you can see on the PPT non-binding terms. That means any term sheet issued to you, it is not binding both the parties. Why? Why the term non-binding came into being. Today, what is really happening with most of the investors like us is we look at founder, we look at pitch deck, we discuss with you, we understand your business, we feel everything is fine, and we'll issue the term sheet. Then what is really happening after issuance of term sheet? We are doing the due diligence, business due diligence, financial due diligence, and legal due diligence. We observed in some of the startups that they are not paid GST for 5 months. The total outstanding GST payable is 25 lakhs. We observed some of them has not paid TDS. The total outstanding paid is 20 lakhs. We observed they bought a third party loans into the company in his name and in his director name to the extent of 1 or 2 crores, which has to be repaid when you raise the funds, which you don't disclose in the pitch deck. I'm just giving you throwing some ideas, which is really happening. Then you came and justified me saying that Rathnakar, I need $1 million, which is equivalent to 8 crores today. The milestone is this what I am going to achieve. I said, okay, this with this money, he can achieve this milestone. I'll give you one example. In one of the company where we funded around 2.5 crores, he said, Rathnakar, with 2.5 crores, I'll reach a milestone where a Series A investor would like to keep money. This is a bridge round. We said it is good, let us put the money because he reached X and he want to reach Y. At reaching Y, there is a Series A investor who wanted to give the term sheet. When we given 2.5 crores to him without doing due diligence, you know what he has done? Around 1.5 crore only gone to clear his vendors, to clear his statutory liabilities, to make some past payment of his employees, and he is left with 1 crore. And 1 crore also, what really happened? It was able to sustain for 5 months. After 5 months, his money is out. When he came for bridge round, he said he will achieve certain milestone. This money is sufficient for 12 months. It gone for a toss. We were all surprised what really went through. That's the reason we said due diligence is must in all the cases. If you look into large VCs, angel networks, they say due diligence is must. Without due diligence, they don't want to put money into your company. So, sir, then if due diligence is happening, we found these conditions. I have to change. Either I need to agree that I am going ahead with your investment, or I need to say still I will go ahead, but I wanted to change the conditions because I will not allow you to repay your statutory liabilities. I will not allow you to repay your unsecured loans till you raise the last series A. I will not allow you to pay so and so amount because you have to reach that milestone. I can put that conditions. If I once when I will know when I have all this data, then I can revise a binding term sheet on you saying that this is the final. We both agreed. Till that time, the word non-binding term sheet will come in play because we've seen with many startup founders, they are not good in managing their books of accounts because money is not there. They are not good in filing their compliances. Most of them doesn't know there is a compliance. They think we are a startup, we can take care of certain things. We also found out they say we have applied for a patent. Actually, patent application was rejected. Some are in the process. He doesn't know whether the patent will come or not. There are a lot of subject matters. Some say we have a trademark, but there is a dispute on the trademark. We also had that issue. All these things we come to know only in the due diligence. Then we changed our terms. Till that time, any term sheet you received, it is called non-binding term sheet. Once I said binding means I have no, irrespective of the outcome of the due diligence, since I agreed, this is a contract act. Again, I'm saying contract act. When I say binding, irrespective whatever happens, because I agreed the terms, I have to oblige. I cannot go back. Understood now? If any party, investor has given a binding term sheet where you both signed, irrespective of the transactions, he has to oblige this condition. There is an obligation on him. That's why internationally and in India, all the term sheets are non-binding term sheets. They are not binding term sheets. I hope you got very clear clarity what is non-binding term sheet. And first and foremost, I've spoken about the valuation. The stakes and other things will come in place. Understood now? Now, the important question a lot of people ask me in term sheets of large VCs or an angel network today, they say we will issue an instrument called compulsory convertible preferences (CCPS), or will issue a term sheet called instrument called CCD, compulsory convertible debentures. Sir, why they don't ask equity shares? Why they are putting this CCPS, CCD? Why I need to issue preference share to investors? Why not I issue an equity share? I hope a lot of people would have doubts because I'm speaking about voting rights here. What I'm speaking about. You should have got doubts, right? Why? See, under Companies Act 2013, once you issue an equity shares is the shareholder of the company. The rights of equity shares are same. Either it is a founder or it is an investor, there is no change. And you all know there are certain rights which board has an authority, they can take it. There are certain rights a shareholder has to approve. There is a 51% of the shareholders approves, it is a pass through. In one or two special cases, 75% of the shareholders has to agree, it will be pass through. There are clear terms agreed. For example, when I said again, go back to our initial discussion, I am a financial investor putting in money, not knowing what you are doing. But I wanted to help you to guide and see that the money has been invested. The money has been invested as agreed between both the parties for the desired terms. How do I control? Companies Act will not permit me to control if I am an equity share. Understood? Who has an authority above equity shares? It is called as a preferential shares. Person who holds preferential shares has an authority on the board, has an authority on the equity shares. Without approval of preferential shareholders, any conditions passed by the board or the shareholders, it become void ab initio. It is the word they use is void. That particular resolution has no logic. I can go to the court of law and turn around all your decisions back. That is only possible if I issue a preferential shares. Sir, then you call it as preferential shares. Why you are calling as CCPS, compulsory convertible preference shares? Now, that's what I always tell to many of my startup friends. It is like a relay race. There is a 4 by 4 relay race. What really happens? I take your baton as an angel investor at early level. I'll take here, I'll run and I'll hand it over to other number. That is, I'm a seed investor. I'll run you to through Series A. Series A guy, I would have put 1 million. Series A guy would have put 10 million. Today, Series A has become a $10 million, 5 to 10 million. Since he has put larger money in the company, he will sit in the driver's seat. He will make me to sit in the back seat till the time I was driving it. So when they don't want angel investors or seed investors to drive the company, they say convert your preferential shares into equity shares because you don't put any authority now. They shouldn't come back to you again and again asking, can I invest? Can I buy this thing, fixed assets? Can I change my business decision? He has no role. You don't want him to play a role because your role is done. So they said at that you read into the term sheet when the CCPS will get converted into equity shares is when you raise a qualified financing round of so and so dash. The dash is Series A. For Series A, it is a Series B. For Series B, it is a Series A. Understood? No. They want that compulsory conversion should be there. If that compulsory conversion is not there, many of the Series A, Series B, Series C founders found it very difficult to invest because they don't want to go back again and ask that guy, Are this guy has put 1 million, I put 10 million. For any decision, I also need to go back and ask him. I also need to take a decision. I don't want to get into these troubles, Baba. Let him get converted in equity share, let him drive. I am not bothered. I wanted to drive the company. I will decide because I am putting the larger amount. That is the word CCPS has come. CC, compulsory converter, has came because of that objective. I hope you all got the clarity. Why it is CC is because of that objective. Why is preferential shares is because I have to overrule all the decisions of the board and shareholders. Understood, right? Now, what is CCD? I also see a lot of cases CCD, compulsory convertible debentures. Why company issue debentures? See, what happened is in many of the cases, investors have a doubt that this particular business model will work or not. I don't want to become a shareholder now. I'll become shareholder later. Let my money is treated as debt in the company because debt holders have certain rights over and above the shareholders. You all agree, right? The debt is above the shares always in terms of recovery of the money. Correct. So that's the reason. Second, there is other way around also. The startup entrepreneurs, they are also saying, I don't want to give equity right now. I don't want you to rule so many things that I will rule this. I'll take your money as a debt. Let me do my job. If I'm not doing, I have an obligation to repay. But if I'm doing, as since you have issued a debt, I'll convert into equity at some point of time. You will not have rights like a overruling my decisions of equity shares holders, overruling the decision of the board. You will not have it. Understood, no? So that's why they issued a debentures, that is a debt component, which is compulsory convertible. Again, to comfort the second level of funding, the second, third, fourth, whoever is coming at later level, for them the comfort is needed. So that is the reason they use debt, CCD or CCPS. So most common instrument is called CCPS. What are the terms you are using in term sheet? What are rights you are giving to investors? It is valid only if you issue preferential shares. Otherwise, it is not valid. Please understand. How it is valid? In your generally when you issue the preferential shares with rights, lot of angel networks, lot of angel investors, though they are issuing CCPS, they cannot sue company. They can sue only the promoters. If you look into the legal obligation. Sir, why can't I sue a company? When you issue a preferential share with rights, the articles of association of the company need to be modified, saying that the preferential shareholders have these rights. Then only I can sue company, I can sue promoters. A lot of people don't do that actually. Because it is an Herculean task, we avoid it. Understood? So the instrument plays the second important position. Now, what are the other rights which we discuss in the term sheet? I am coming back to the rights. Very important point is board seat. Most of the people will ask for board seat or board observer seat. Why they need board seat? Because I said they wanted to drive it. They want to get into the board. It is left to the decision of the founder whether you want to give board seat or not. Sometimes it is a negotiation factor that investor want a board seat, but he wanted to use that right whenever he feels there is something wrong with the company. They don't want to use, otherwise they want to have that right. The second thing they look at thing is most beneficial right. What is most beneficial right? You issued one term sheet to me and you taken money, you signed SHA. After that, you were troubling. There is one more investor came. He asked for some additional right than the right what I have asked for. There are 13, 14 rights are there, but I would have got only 7 rights. He would have got another 2 rights more. So most beneficial right is what they mentioned it that they mention in the term sheet. That means if you are giving any beneficial rights over and above the rights what I hold, automatically the rights will is also applicable to me as long as the shareholding CCPS is not converted. The third thing they look at is preemptive right. What is preemptive right? Any action taken by the company, either issuance of share, changes business holding, a change in business, recruiting people, anything where board and shareholders has to take an approval, they have to come to me. Preemptive is they have to come to me take my approval, then only you can go and do the transaction. That is called preemptive right. Please read this word, preemptive. What is that they are covering in preemptive right? Lot of people will write, for what aspects you need to come to me for approval. Without my approval, if you are doing any transaction, that is null and void. Please understand. Understood? The third one is preemptive. Fourth one is ROFR. You heard ROFR, right of first refusal. ROFR rights, very commonly people call as ROFR, right of first refusal. If you are issuing any further fundraise, you are selling your company to any third party. If founders are selling shares to any other third party because he needs money and it is a need, the right of first refusal will come to the shareholder whom I am holding today. There are many transactions where you will come back, but generally further issuance of shares, in case of M&A sale of company, in case promoter is selling some of his stakes, if there are two founders, we have seen in many cases, there are three founders are there, one founder is not happy. In one of our company, what happened? There were three founders. One of the founder is from Costa Rica. He got a girlfriend in France. He got married and moved to France. Then he decided to sell his shares to other two co-founders. It is natural because he said, I have no more party, I want to sell. But what is the problem here? The ROFR right is lying with investors like us. So when he has offered that shares, the ROFR right will come back to us. So Rathnakar is selling so and so share rights. And where is that? It will go. Yes, it has to be informed to us. Generally, we agree, give it to the founders because we don't want to take, but the information need to come off. The fifth thing is anti-dilution rights. What is anti-dilution rights? Very simple. You issued your shares at certain value to me. For example, you issued a shares at a pre-money valuation of 20 crores. I invested 4 crores. 24 crores is the valuation of the company. Tomorrow your company has not performed because today in the they call it as funding winter where we are going. Certain companies have done the down round. We call it as a down round where they said instead of issuing at 24 crores post pre then 20 pre money will become 24 post money. Now 24 will become the pre money and he has to issue further shares. That fellow went and sold his company at 18 crores pre money. What will happen? My 24 crores have become 18 crores. So we said anti-dilution will kick in. My shares will be issued at 18 crores instead of 24 crores. The entire shareholding structure will change. I don't want to deprive of my right getting the company at lower valuation than investing the company at higher valuation. It is more larger topic because of lack of time I am not taking, but anti-dilution is a very, very interesting topic. I have many examples where we have set in and seen into this aspect. Whenever the valuation comes down, post investment, shareholder has a right to get his shares on that valuation. You please observe in anti-dilution, they mention a word. What they say is 18 divided by 24. There is a specific calculation. If you see at that, I will get not at 18 crores, I will get my shares at 17 or 16 crores valuation. They put a formula there like that. Please take example of your CA friend or a lawyer, how this anti-dilution kicks in tomorrow if you're taking any decision, how it need to be seen. The sixth condition which we are speaking is drag. See, drag, tag are part of my exit rights. Generally, they call it as exit rights. What is exit rights? We are a financial investor. We are investing in your company with an objective to give my money back at the end of third year, at the end of fifth year, or at the end of seventh year. They clearly write what is my exit horizon, by what time founders are signing the shareholders agreement for an exit. Is it 3 years, 5 years, or 7 years? If you say it is 5 years, at the end of 5 years, you are not given exit. Exit right, I'm saying exit right. Exit can be an IPO, exit can be an M&A, exit can be a buyback, exit can be the next round of strategic investor who wanted to invest company, but they will also give an exit to me. Understood? And exit also comes with an IRR. I hope all would have seen IRR, investor rate of return. See, generally, what really happened? What is IRR? If I invest in bank deposits, I get 8% today. If I invest in savings account, I get 4%. Invest in debt funds, I get 10%. If I get to invest in stock market, my chances of getting return about 12 to 15% is there. That is the reason, historically looking into various asset class, and you are an illiquid asset. Startups are illiquid, unlisted, illiquid, and it is a high risk investment. We don't know whether you succeed or not. I don't know where it will head. That's the reason the IRR stands between 18 to 25% across industry. 18 to 25% based on the experience, expertise, and their negotiation skill. IRR ranges from 18 to 25%. And as a part of exit right, you need to read this drag rate. As a part of exit right, if end of fifth year you are not giving an exit, even if I'm holding 10% stake, even if I'm holding 4% stake in the company, please listen. I shouldn't hold 51, 40, 30 is not a criteria. Even if I hold 10, even if I hold 4%, even if I hold 2%, please understand, if you are given the drag rate, I will identify a buyer where he says, since I am not getting exit, the buyer said, I want to take our 51% company. Under drag rate, I can sell the company. Saying that promoter will sell his 51%, give my money back. You have no obligations to stop it because you signed shareholders agreement and term sheet. Please remember. Please read the drag rate very carefully. Nowadays, many founders are objecting for this. We don't want to do drag rate. We'll do a buyback. If you are not doing a buyback, we'll give certain dividend every on year. That's what most of the founders are doing that. There is another word called tag rate as a part of exit. If founders are selling the company, this has happened in 3, 4 cases, and they're selling the company at certain valuation, automatically investors will be tagged along. The tag is they will get tagged along with the founders who are selling the company under M&A or the founders cannot sell, okay, I will sell my company, let my investors be in, I am not bothered. I wanted to go away. No. Under tag rate, if you're selling the company, even my rights are valid. Understood now? So I spoken about exit, I spoken about IRR, I spoken about drag, I open about tag. Now the one more thing is liquidation rights. What is liquidation rights? Liquidation rights is in case company is unable to perform, decided to get liquidated. We had one company which tried very hard, they did well, but because of competition, they have to close down. They have a lot of assets, chables, trays, machinery, and other things. He decided to sell off, and he also decided to sell off his trademark. All put together, he received 15 lakhs. Under liquidation rights, the first entire 15 lakhs will come back to investors. That is what we are saying. Whatever money you are generating through liquidation rights, founders will not have a right. It is the investors. We are saying investors will overrule founders in case of liquidation. Please read the word liquidation rights very, 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 very carefully. But it is not an entrance. Anyway, you tried, you are losing it. Why investors need to lose money? Let them have some money. That's what we always feel. Liquidation rights are good to have. There is no issue of any point. So exit rights and liquidation rights plays an important role. I spoken about few terms. One is board observer seat, most beneficial right, preemptive right, ROFR I have spoken about it, anti-dilution I have spoken about it, exit rights I have spoken about it, IRR I have spoken about it, drag along, tag along, liquidation rights. I hope you all looked into that aspects. And finally, the last one is information rights. Though under Companies Act, what it said, every shareholder has a right to receive annual report at the end of the closure of the financial year within 180 days. You have to do your AGM and issue there. Beyond that, shareholders doesn't have any rights. Because I am a financial investor, I am saying I need a budget, I need MIS, I need quarterly call, I need information. That is the reason they write it as information rights. Understood? Please read that very carefully. After information right, it is the dispute mechanism where the please read under Stamp Act, the governing law. If you say it is Hyderabad, Telangana stamp duty is applicable. If you say it is Bangalore, Karnataka stamp duty is applicable. If you say the dispute can happen in Bombay, Maharashtra stamp duty is active. So the place at which you are agreeing for a dispute, though the law of India is applicable, the place at which the dispute is applicable, that particular stamp duty is applicable for that shareholders agreement. Please don't. I've seen many founders. Since I stay in Telangana, my investor is in Maharashtra. He said Maharashtra is the place of this thing. They have put a stamp duty of Telangana. Understood? So please be careful. The dispute rights, arbitration rights is what they look at. There are another three, four clauses are there which I think I have covered to a larger extent. Now, what is the difference between the term sheet and SHA? Term sheet is an agreement between both the parties. It is not binded. They call it as non-binding. It is an agreement between the both the parties. No stamp duty has been paid. Under Indian courts, all the Indian courts, forget about arbitration. All Indian courts in India, as per the governance of the state laws, Telangana, Maharashtra, Karnataka, Tamil Nadu, whatever the state, they said no document should be accepted in the court of law, though it is a valid agreement under Contract Act without paying stamp duty. Please understand. If you don't pay stamp duty, that agreement is null and void. There is ways of getting it done valid. That is a different discussion. We need to speak another 15-20 minutes on that. But stamp duty need to pay. And we need to make all our rights as an obligation. To make all the term sheets into a legal agreement and obligation between both the parties, that's where shareholders agreement will come in play. Understood now? Shareholders agreement is a binding agreement discussing about all the points what we discussed in the term sheet today. Everything will be included. Please read shareholders because term sheet will discuss at high level. I always say at 10,000 feet I am seeing the term sheet. Shareholders agreement is grounded. There are many legal words they put in the term sheet. Each has a lot of implications. That's where a lot of times people say for shareholders agreement, take help of a lawyer, not a chartered accountant. Take help of a lawyer to understand what are the critical conditions which can overrule for promoters, company, and him. Under shareholders agreement, there are three parties: promoters of the company or founders of the company. Second is memorandum of articles, the company itself. Third is investors. Investors can sue company, can sue promoters. There are certain rights company no need to oblige, but promoters have to oblige. In shareholders agreement, they clearly mention where the role of share founders plays an important role and why a investor can sue a founder and make his rights viable and right. He cannot sue company so easily, but they can sue promoter. Once you get into legal litigation, there are no investors will come and sit in your place. Please understand. Okay, I'm stopping here at high level. Any Lalita and Mega, any specific comments or questions from the you would have seen during my conversation? Any comments or questions from our viewers?
Yes, sir, there are few questions from our viewers.
Yeah.
I would like to display one of them. How can I get a sense of my pre-valuation before I get out and raise?
Okay, that's what I was saying. Valuation is an art, it is not a science. You have to justify your ask. See, for example, in some, I will tell you today I am getting certain companies. I will not name which sector and other thing. There is a company which is doing around 3 lakhs revenue per month.
Okay.
And he came to me and said, Rathnakar, my company is valued around 50 crores. I would like to raise around 15 crores, 2 million. That's what he came with.
Hmm.
Then my investors have asked a question 3 lakhs into 12, 36 lakhs. Even if I look at 10 times 3.6, 20 times is, uh, sorry, 7.2 lakhs, 7.2 crores. He is asking 50. So it is almost 100 times of his turnover. Is it justifiable for this guy to invest now at that valuation? You got it? No. They were totally surprised why I need to value so and so company. But I said I had to look into that and justify. But they said generally for Series A investment, if somebody is doing 3 lakhs a month, he has to move from 3 lakhs to 1 crore revenue. Once you reach a GMV of 1 crore, GTV of 1 crore, or revenue of 1 crore, then only you are eligible for Series A.
Correct.
And the kind of investment you need is much larger than what you thought. Unless the investment low is sufficient, considering cost of customer acquisition, they said at this level and valuation we will not invest because he needs two more rounds of investment before he goes there, and his cap table is an issue. So we have to reject. So it is an art. How do you identify, adjust, and do it? So you need to be very careful at the valuation and kind of achievements you need to do today in the market.
Correct.
Yeah, Lalita, and
So,
you can reach out to me also directly. Yeah.
yeah. So there is a one question. When can I shareholder transfer a share?
Sorry, one thing I forgot is promoter lock-in. Shareholders can transfer anytime their shares. They have no restrictions. Generally, there are no restrictions on shareholders. Investors who are putting money on their shares. For promoters, they put a lock-in. Why they put a lock-in is sometimes promoters, founders, what they do is they want a co-founder. They immediately transfer the share. They want some advisor. They will transfer. I see many founders come. Rathnakar, I know I agreed with the investor that I will not increase my share, but this is a good advisor. I will give 2% of my stake to him. We are clearly saying you can't do that. That's why we said promoters, shareholders, don't commit anything to your advisor. Since investors are already in place, bring advisor, you come and speak, discuss why it is advisor is important, what is the value add he is going to bring on the table, why you wanted to give certain number of shares, take an approval. That's why I think you need to observe founders lock-in is very critical, and it get vested over a period of 4 years, 25, 25, 25. Sometimes it is 3 years, 33, 33, 33. They are allowing them to do after completion of 1 year, not before completion of 1 year from the date of investment of the shares. Shareholders, investors can transfer anytime once they are there. There is no issue for them.
Uh,
Any other question, Lalitha?
yeah. Yeah. So there is a question. Besides capital, what else should I be asked from an investor?
See, two things. Sometimes you need investors for money. Sometimes you need to choose investors who can bring value to your startup. See, most of the today, at least this decade, till the end of this decade, we see most of the entrepreneurs who are coming in India are first generation. They never seen the cycle. They may be good in technology, they may not be good in finance. They can be good in technology, business administration, they are bad in marketing. They can be good in marketing and sales, they are bad in financial management and operations. Some of the startups doesn't know how to delegate also. You cannot be jack of all. Please understand. You have to bring people on the place. That's where you can seek investors' guidance. Sometimes you need an entry into one particular sector, one particular large company. For example, we have investors at our end who can introduce to some of the large companies where you are trying to go and knock the door, but they with the phone call, we invested in this company. This guy is doing a great job. He will come and test his product. Allow him to do POC because that is the maximum people can do. Beyond POC, it is your product and you have to speak. But for getting POC, they will help you. So this is what I am saying at angel investors and angel networks, can they bring that value to you or not is what you have to look at. And the shareholders agreement will be varied as shareholders agreement varies based on what you agree with the investors. A Series A investor has different terms. Angel investor has different terms. Angel networks will have different terms. For example, Mumbai Angels, Hyderabad Angels, Chennai Angels. Some of our terms varies, but most of the terms are common. But there will be a varies in the terms and conditions.
So I guess we are reaching toward the last question of our viewer, and that is how can the shareholder agreement be varied?
It depends here. For example, nowadays, to say you, startup founders are more clever than investors. What they are saying, Rathnakar, that particular investor is putting only 50 lakhs. There is another investor is putting 3 crores. There is one more investor is putting 2 crores. How do I give the same rights to all the investors? A person who has put 50 lakhs, I don't want to give certain rights. A person who put 3 crores, I want him to a lead investor, I'll give him certain rights because he has put larger money believing in me. Understood? No, that's the reason the share in the same shareholders agreement, different types of shareholders, different rights are there, and they are varied. Founders are seeking that based on the investment what each people is putting. You got it, no? Generally, we are insisting for same rights, but we see lead investors also saying, "Are Baba, I put 3 crores, you put 50 lakhs, and you and I are sitting in the same position. I am not liking it. Let me have certain rules over it. I will ensure that it is growing to next level. You will also get benefited, but support us wherever it is needed." That's what they are saying to us.
So I
Any other
guess with
question?
this, sir, we have addressed all the questions from our viewers. So first of all, I would like to thank you for taking out your time and sharing your valuable lessons and knowledge with us about the term sheet and shareholders agreement. आई होप हमारे जितने भी व्यूअर्स हमारे साथ जुड़े हुए हैं पिछले 15 दिनों 11 दिनों से उन्होंने काफ़ी कुछ इन्वेस्टमेंट के बारे में जाना और टर्म शीट के बारे में आज उन्होंने जाना. So thank you so much and wish you a very happy Makar Sankranti from on the behalf of Jabalpur Incubation Center, and I would like to thank Rathnakar sir for coming today in the occasion of Makar Sankranti as share and sharing you with knowledge, lots of knowledge with us. So thank you so much, sir.
Thank you. Thank you. Actually, I have to thank you and also viewers who have patiently came and listened to me. I thank you all. You can reach out to me on LinkedIn for any queries, and you can reach out to Jabalpur Incubation Center because people will have doubts who don't want to come in public. And I'm willing to answer either on mail or we can have a one on one session later. Please feel right to reach out. There is no issue. I thank you all and thank you, Jabalpur, for the opportunity. Thank you a lot.
Thank you so much, sir. And thank you, Megha, for conducting such an amazing topic and webinar for us. Thank you so much.
Thank you.
Thank you, Lalita. Thank you, sir.